Most traders enter a position and watch it collapse, not because the market is random, but because they skip the 9 tests that separate a high-probability trade from a gamble. Take AAPL in 2009, it had a selling climax, an automatic rally, higher highs, higher lows, 7 confirmed signals before the markup even began. The Composite Man had already laid his trap, those 9 Wyckoff buying and selling tests. That's your key to reading his next move before the crowd even notices. Every day, thousands of traders sit before their screens, placing orders based on gut feeling, news headlines, or a moving average crossover, and every day, the market swallows their capital without hesitation. They enter too early, too late, or in entirely the wrong direction. They watch a position turn against them within hours of entry and ask themselves the same agonizing question. Why does this keep happening? The answer is not bad luck. It is not a rigged system. It is something far more precise and far more correctable. You see, the market does not move randomly. Behind every price swing, every volume surge, every deceptive breakout, there is a deliberate campaign being orchestrated by large professional interests, what I call the Composite Man. He does not announce his intentions. He does not ring a bell at the top or the bottom. He operates through price and volume, leaving footprints that only the trained eye can detect. And the untrained trader, he walks directly into every trap set for him. Now, before you assume that reading the Composite Man's intentions requires years locked away studying obscure charts, pause. The mechanism already exists. It has been tested across decades of market behavior, through bull markets and devastating crashes alike. It is the 9 buying and selling tests, and their first and most fundamental purpose is this: they define the line of least resistance in the market. In modern trading terms, this concept is everything. When you open a position in any stock, whether it is a technology giant like Apple or an emerging sector ETF, you are, consciously or not, betting on a direction. The line of least resistance tells you which direction carries the least opposition from supply or demand. In an accumulation phase, once supply has been absorbed by large interests, the line of least resistance turns upward. In a distribution phase, once demand has been exhausted, that line turns sharply downward. The 9 tests exist precisely to confirm which line you are standing on before you commit your capital. They examine whether the downward stride has been broken. They ask whether higher lows and higher highs are forming. They demand that volume behavior confirm the direction of the move, expanding on advances, contracting on reactions for a developing uptrend, or doing the exact opposite before a markdown begins. Applied to today's markets, this framework works with equal precision. Whether you are analyzing the S&P 500 futures at midnight or reviewing a Nasdaq-listed stock before the opening bell, the structure of supply and demand never changes. Human behavior does not change. The Composite Man, represented today by institutional algorithms, hedge funds, and investment banks, still accumulates quietly, still distributes cleverly, and still exploits the impatient retail trader who enters without verification. When the majority of these 9 tests align in your favor, the market itself is telling you where it intends to go. That alignment is your permission to act, and your protection against acting blindly. The line of least resistance is not a mystery. It is a signal. Learn to read it, and the market transforms from an adversary into a roadmap. There is a moment every trader knows intimately, the moment you watch a stock collapse violently, bars dropping one after another on heavy volume, and every instinct inside you screams that the bleeding will never stop. The news is terrible. Social media is flooded with panic. Fellow traders are calling it the end of the move, the destruction of value, the point of no return. And so you do what the crowd does. You stay away, or worse, you sell into the very bottom that was being constructed for your benefit. This is precisely where the Composite Man wants you. Paralyzed, emotional, absent, Because while the public is panicking, something methodical and deliberate is taking place beneath the surface of that chaos. Large professional interests, the institutional funds, the market makers, the entities with the capital, and the patience that retail traders simply do not possess are absorbing every share being thrown at the market in fear. They are not running, they are accumulating, and they are leaving behind 4 unmistakable footprints for those trained to see them. These 4 footprints are what buying test 82 demands you identify before placing a single dollar into a long position. First comes preliminary support, the earliest sign that significant buying is beginning to emerge beneath a prolonged downtrend, where volume increases and price spread widens, signaling the down move may be nearing exhaustion. Then arrives the selling climax, that dramatic, high-volume capitulation bar where panicky public selling reaches its peak and is absorbed entirely by professional interests, often closing well off its low. Following this comes the automatic rally, a swift price advance that occurs simply because the intense selling pressure has been removed, fueled further by short covering. Finally, the secondary test revisits the area of the selling climax on noticeably diminished volume and narrower spread, confirming that supply has been genuinely absorbed and not merely paused. In modern markets, this sequence appears with remarkable regularity. Consider any major index correction, the sharp COVID crash of March 2020, the Nasdaq sell-off of late 2022, each concluded with these exact 4 structural events playing out in sequence. The selling climax produced the low. The automatic rally defined the upper boundary of the trading range. The secondary test confirmed that institutional hands had absorbed the available supply. Every element of buying test Fate 2 was present, visible and readable on the bar chart for any disciplined analyst willing to look beyond the noise. This is what separates the professional from the perpetual victim of the market. The professional does not need certainty, he needs confirmation. And when preliminary support, a selling climax, an automatic rally, and a successful secondary test align together, that confirmation is delivered with structural authority. The foundation has been laid. The Composite Man has completed his collection. Now the only question remaining is whether you were watching or whether you were still reading the headlines. Ask any struggling trader what their greatest frustration is, and the answer is almost always the same. They read the direction correctly, they identified the stock, they entered the position with confidence, and still the trade failed. The price moved exactly where they anticipated, yet somehow they were stopped out, shaken out, or simply bled out before the real move began. They did everything right, they insist. And technically, on price alone, perhaps they did, but price alone is half the story. And half the story in this market will cost you everything. The Composite Man is sophisticated. He does not simply move price in one direction and invite you along for the journey. He tests you first. He creates price movements that appear convincing on the surface but carry no volumetric weight beneath them. A rally that looks promising but occurs on shrinking volume is not a rally being supported by genuine demand. It is a rally being allowed to happen while supply quietly enters above. A reaction that appears alarming but occurs on contracted volume is not distribution. It is simply the natural exhale of a market preparing for its next advance. This is precisely what buying test Fate 3 measures, and it is the difference between reading the market's intention and merely watching its performance. The principle is direct and applicable in every modern market environment. In a developing uptrend, volume must expand on rallies and contract on reactions. When this relationship holds consistently across multiple price swings within a trading range, it confirms that large professional interests are in control of the demand side. They are absorbing weakness and supporting every advance with genuine institutional participation. The activity is bullish, not because price said so, but because volume confirmed it. The mirror image governs distribution. When volume contracts on rallies and expands aggressively on reactions, the composite man is revealing his hand on the supply side. He is unloading shares into every bounce the public attempts to buy and accelerating downward whenever demand exhausts itself. The activity is bearish, regardless of how constructive the price structure may appear to the untrained eye. In today's markets, where algorithmic trading, dark pools, and high-frequency activity create extraordinary complexity, this principle remains your anchor. When analyzing a modern stock like a semiconductor leader or a broad market ETF, strip away the noise and ask one question: is volume confirming the direction of price or contradicting it? A breakout on declining volume is a warning. A pullback on declining volume within an established uptrend is an opportunity. The effort versus result relationship never lies because institutions cannot hide the footprint of their volume. Only the retail trader lacks the discipline to read it. When price and volume finally speak the same language, expanding together on advances, quieting together on reactions, the market is no longer ambiguous. It is communicating with absolute clarity. That clarity is your edge, and it has been available on every chart in every era for those willing to listen. There is a particular kind of pain reserved for the trader who selects the right market direction, times the entry reasonably well, and still manages to choose the one stock in the entire sector that refuses to participate in the move. The index advances powerfully. Neighboring stocks in the same industry surge with conviction, and yet the position sits there sluggish, reluctant, bleeding small losses while everything around it flourishes. The trader stares at the screen wondering what invisible force is holding his chosen stock back. That invisible force has a name. It is called relative weakness, and selecting a stock that carries it into a long position is one of the most quietly destructive mistakes a trader can make. Before abandoning the idea of stock selection entirely and retreating into index trading out of frustration, understand something fundamental. The problem was never the market. The problem was never even the timing. The problem was that a critical filter was missing from the selection process, one that Wyckoff identified as absolutely non-negotiable before committing capital to any position in either direction. That filter is comparative strength analysis, and buying test 57 demands its confirmation before any long trade is justified. The principle operates with elegant simplicity. In a developing uptrend, the stock you select for a long position must demonstrate that it is stronger than the broader market. Specifically, it must be more responsive than the market index during rallies, advancing further, faster, and with greater conviction, and simultaneously more resistant during reactions, declining less and recovering more quickly than the index itself. This behavioral pattern reveals that large professional interests have already chosen this stock as a vehicle for their campaign. The composite man does not accumulate weakness. He selects the strongest instruments available and concentrates his demand there. The selling counterpart is equally precise. For a short position, selling test 54 demands that the stock be demonstrably weaker than the market, more responsive on reactions and noticeably sluggish on rallies. When a stock cannot advance meaningfully, even as the broader index pushes higher, it is communicating that supply overhead is overwhelming whatever demand attempts to emerge. In modern trading, this analysis is more accessible than in Wyckoff's era, when charts were compared by physically placing one beneath another. Today, the relative strength ratio between any stock and its relevant market index can be plotted instantly, revealing points of divergence and confirmation across any time frame. When the S&P 500 makes a new high and a stock in your watch list simultaneously makes a lower high, that divergence is not coincidence. It is the market's most honest assessment of where institutional interest is absent. Applied consistently, comparative strength transforms your watch list from a collection of possibilities into a precise, ranked hierarchy of probability. The strongest stocks in a bull phase and the weakest stocks in a bear phase represent the composite man's own selections made visible through the chart for those disciplined enough to look. Trade in harmony with that selection, and you are no longer guessing, you are following. There is a confession that most modern traders will never make publicly, but carry privately every single day. They have absolutely no idea where a trade should end. They know roughly where they want to enter. They place a stop loss somewhere beneath a recent low, often chosen more by comfort than by logic. But the price target, the destination that justifies the entire risk of the trade, is selected arbitrarily. A round number, a previous high, a percentage gain that simply feels satisfying. And when the market inevitably reaches a point of genuine resistance and reverses, they are either already out too early or holding desperately through a turn they never anticipated. Trading without a measured price objective is not a strategy. It is hope wearing the costume of analysis, and yet the majority of retail traders operating in today's markets, across stocks, futures, cryptocurrency, and forex, enter positions every single session with no scientifically derived destination in mind. They are navigating without coordinates. They are measuring reward against risk using instruments they constructed from imagination rather than from the market's own structural evidence. Before concluding that precise price targeting is impossible, that markets are too complex, too algorithmically driven, too unpredictable to project with any meaningful accuracy, consider that this problem was solved over a century ago. Not through speculation, not through mathematical modeling divorced from price reality, but through a direct reading of the cause that the market itself builds during every trading range it forms. This is the fundamental genius of the point and figure count, and it is why buying test find 1 and buying test 89, confirming that the downside price objective has been accomplished and that the upside profit potential is at least 3 times the initial risk, can only be satisfied through point and figure chart analysis. The logic is rooted in Wyckoff's law of cause and effect. Every trading range, every period of accumulation or distribution represents a cause being constructed. The horizontal width of that trading range, measured column by column on the point and figure chart, quantifies exactly how large that cause is. The subsequent price movement, the effect, is directly proportional to the cause that generated it. A narrow trading range produces a modest move. An extended accumulation base produces a powerful, sustained markup. The P&F count measures the width of that base and projects, with remarkable precision, how far the resulting move can travel. In modern markets, this methodology applies across every liquid instrument available to today's trader. Whether measuring the accumulation base forming in a large cap technology stock after a significant correction, or calculating the distribution calls built into a commodity futures contract before a major markdown, the point and figure horizontal count delivers objective, structurally derived price targets that remove arbitrary guesswork entirely from the equation. When your measured upside objective confirms at least 3 times your defined risk on the trade, the position justifies itself mathematically before a single share is purchased. That is not optimism. That is precision, and precision protects capital. There is a specific moment in every trader's journey that defines whether they will ultimately succeed or remain permanently frustrated by the market. It is not the moment of entry. It is not the moment of exit. It is the moment just before both, when all the analysis has been conducted, all the signals have been examined, and one final question demands an honest answer: has the market genuinely completed its preparation, or is the trading range still unresolved, still dangerous, still capable of trapping everyone who enters prematurely? Most traders never ask this question with sufficient discipline. They see a pattern that resembles what they want it to be, and they act. The base looks almost complete. The crown looks nearly finished. Close enough, they decide, becomes the justification for premature commitment, and the market, operating with mechanical indifference to their impatience, extracts its penalty without hesitation. The composite man is never in a hurry. His campaigns are built on patience that the retail trader structurally cannot match, not because of intelligence, but because of the psychological pressure that undeployed capital creates. He constructs his accumulation base across weeks and months, absorbing every available share at low prices before markup begins. He builds his distribution crown with equal deliberation, exhausting every pocket of demand at elevated prices before the markdown unfolds. And he waits with absolute composure until that construction is genuinely complete before launching his campaign in either direction. This is precisely what buying test Fate 8 and selling test Fight 8 demand. You confirm before sealing your trade decision. For the long trade, test Fate 8 requires that a genuine base has formed, a sustained horizontal price structure visible on both the bar chart and the point and figure chart, representing accumulated cause sufficient to support a meaningful markup. This base is not a single consolidation candle or a brief pause in a downtrend. It is a structured, extended period of equilibrium during which supply has been methodically absorbed and the foundation for a new uptrend has been architecturally established. Its distributional mirror demands the identification of a crown, that lateral price movement at elevated levels where the composite man has been systematically unloading his inventory into every wave of public buying enthusiasm. The crown represents completed cause in the opposite direction, a reservoir of supply overhead that will suppress every subsequent rally attempt and accelerate the eventual markdown. In modern markets, identifying the base or crown with precision requires combining bar chart structure with point and figure horizontal counts, a technology stock consolidating for 6 months after a significant decline, building higher lows within a defined range while volume contracts on downswings, is constructing its base in real time. A previously dominant sector leader trading sideways near all-time highs on progressively weakening volume, failing to make new highs despite broad market strength, is forming its crown with equal visibility. When the base or crown is confirmed structurally, volumetrically, and through P&F measurement, the composite man's preparation is complete. His campaign is about to begin. The only remaining question is whether you are positioned with him or against him. After everything you have now absorbed, every principle, every test, every structural signal examined across these 6 keynotes, there remains one truth that will determine whether this knowledge transforms your trading or simply becomes another concept you understood intellectually but never applied with conviction. And that truth is this: understanding the 9 tests is not enough. The market does not reward comprehension. It rewards disciplined, systematic execution, and the distance between those two things has destroyed more promising traders than any market crash in history. You have watched positions collapse despite correct directional bias because volume was never confirmed. You have entered trades on patterns that appeared complete only to discover the base was never genuinely formed. You have selected stocks that moved in the right direction while your chosen position sat motionless because comparative strength was never evaluated. You have taken profits too early or held losses too long because no measured price objective was ever calculated with structural integrity. Every one of these failures has a name within this methodology. Every one of them has a test that would have prevented it. But before accepting that mastery of this approach is beyond reach, that the composite man's campaigns are too sophisticated, too institutionally resourced, too algorithmically reinforced for the individual trader to successfully navigate in today's modern markets, recognize what these 6 keynotes have collectively demonstrated. The 9 Wyckoff buying and selling tests form a complete, interlocking system of verification. The line of least resistance, tells you which direction carries the lowest opposition. The foundation signal of preliminary support, selling climax, automatic rally, and secondary test confirms that professional accumulation has genuinely occurred. Volume behavior removes all ambiguity about whether activity is authentically bullish or bearish. Comparative strength ensures that your selected instrument is aligned with the Composite Man's own campaign. Point and figure counts deliver objective price targets that transform arbitrary hope into measured expectation, and the confirmed base or crown seals every trade decision with structural finality, ensuring you never again commit capital to a preparation that remains unfinished. Applied together in sequence, with patience and consistency, these 9 tests function in today's markets with precisely the same authority they carried in Wyckoff's era. The instruments have changed, the technology has evolved. The Composite Man now operates through quantitative algorithms, dark pool accumulation, and high-frequency distribution mechanisms. But human behavior, the panic of the retail seller at the bottom, the greed of the public buyer at the top, has not changed by a single degree, and it is human behavior that the 9 tests were designed to decode. The market has always been, and will always remain, a mechanism for transferring wealth from the impatient to the disciplined, from the emotional to the systematic, from those who react to those who read. You now possess the reading framework. The Composite Man's next campaign is already being constructed on a chart somewhere, in plain sight, waiting to be identified. The only question that remains is whether you will be watching with the 9 tests in hand when it begins.